A debt ceiling crisis is a situation where the U.S. government is at risk of defaulting on its obligations because it has reached its legal borrowing limit and Congress has not agreed to raise it. This could have serious consequences for the economy, the financial markets and the global reputation of the U.S. as a reliable borrower. So how can investors prepare for a debt ceiling crisis and protect their portfolios from potential losses? Here are some strategies to consider. Diversify your portfolio. A diversified portfolio is one that has a mix of different types of assets, such as stocks, bonds, cash, commodities and alternative investments. This way, you can reduce your exposure to any single asset class that may be affected by a debt ceiling crisis. For example, if you have too much exposure to U.S. Treasury bonds, which could lose value or face delayed payments in a default scenario, you may want to diversify into other types of bonds or assets that are less sensitive to interest rate changes or credit risk. Hedge your risks. A hedge is a strategy that involves taking an opposite position to your main investment to offset potential losses. For example, if you are worried about a stock market crash due to a debt ceiling crisis, you may want to buy put options on an index fund that tracks the market. A put option gives you the right to sell the underlying asset at a specified price before a certain date. If the market falls below that price, you can exercise your option and sell at a higher price than the market value, thus making a profit and offsetting your losses from your main investment. Buy safe haven assets. Safe haven assets are those that tend to retain or increase their value in times of uncertainty or turmoil. They are usually seen as less risky and more stable than other assets. Examples of safe haven assets include gold, silver, Swiss francs and Japanese yen. These assets may benefit from increased demand and appreciation in a debt ceiling crisis, as investors seek to preserve their wealth and avoid currency devaluation or inflation. Take advantage of market opportunities. A debt ceiling crisis may also create some opportunities for investors who are willing to take some calculated risks and look for bargains in the market. For example, some stocks or sectors may be undervalued or oversold due to panic selling or fear. These may offer attractive entry points for long-term investors who have done their research and have confidence in the fundamentals and prospects of these companies or industries. Stay calm and informed. Finally, one of the most important strategies for investors in a debt ceiling crisis is to stay calm and informed. A debt ceiling crisis can generate a lot of noise and confusion in the media and the public opinion. It is important to avoid emotional reactions and knee-jerk decisions based on rumors or speculation. Instead, investors should rely on credible sources of information and analysis, such as financial experts, reputable news outlets and official statements from the government and the Treasury Department. They should also monitor the developments and progress of the negotiations between Congress and the President, and be ready to adjust their strategies accordingly.